Hey everybody, part 4 of the tax planning series. This is really an important one, but the last one, if you missed part 3, you need to go back and watch that. Understanding the difference between IRA money, Roth money, and everything else becomes incredibly important. But now we're going to start moving on to how do we utilize all this information we learned in part 1, 2, and 3, all right? So today we're going to focus on maximizing the tax bracket that you're in. And specifically, if you're in the 12% tax bracket, we have to take advantage of this, okay? Because we are in historically the lowest taxation we've seen since the Great Depression. So we do have to understand that although you might not like paying taxes, it is still the lowest tax rates we've seen in quite a long time. And if we do nothing in 2026, the tax rates are going to go back up to the 2010, 11, 12 range, okay? So let's look at what we need to do. 2026, 12% goes to 15%, 22 goes to 25, 24 goes to 28, so forth and so on. So the tax rates are going up in 2026 if nobody does anything, which we're good at that. At 73, they moved that required distribution out a year again. So now at 73, we're going to be forced to withdraw money in the form of required minimum distributions. This is what wreaks havoc in most people's retirement tax situation, all right? Because by 73, we have all of our income coming in. Any pensions have been triggered, Social Security has been triggered. And sometimes these required distributions push us into much higher tax brackets, and we don't even need that extra income. So we find that to be a big problem out there, and we see it happening quite often. So required minimum distributions are based on the total amount of IRA money, pre-tax savings that you have out there. So we need to be proactive. The day you retire, the day your income goes down, we need to focus on being as efficient as we can and utilize the lower tax brackets as much as we can. Okay, so we're going to pull out as much as we can, especially at 12% taxation. Use what you need, convert the rest to Roth. Consider delaying Social Security so you can use more of that IRA money at lower taxation and then have a higher Social Security later. Especially between now and 2026, that really does become a viable option to hold off taking Social Security. Regardless of how long you think you live, we've got this opportunity to take money out of that IRA at lower taxation. So we need to know our tax brackets and how much income we have, okay? In part 2, I went through all the different tax brackets. I went through the standard deduction. This is the culmination of the two. This includes the standard deduction, and it's increased for being over 65. So if you're under 65, single people, it's $1,850 less on each of these numbers. For married couples, it's $3,000 less on each of these numbers if you're under 65, okay? So if you're over 65, this is a really handy chart. Okay, I put a 0% tax bracket because that standard deduction is $15,700 for a single person, $30,700 for a married couple. Okay, and that's effectively a 0 tax bracket. Then we pay 10% taxes. So for married couples between 30,000 and 52, from 15 to 26 for single people. And then there's that magical 12% tax bracket. You have all the way up to 120,000 as a married couple and 60,000 as a single person. That is incredibly important. There's huge opportunities. If you're a married couple and your taxable income for the year is $100,000, well, you've got room to work with. Okay, so how do we work with this? What do we do with this knowledge? This is not just for people in the 12% tax bracket. We have plenty of clients and we know plenty of people that are permanently in the 22 and above tax brackets. Even 22% and 24% are great opportunities right now because again, in 2026, those tax rates are all going up. So if your pension and Social Security and all this guaranteed income and your required distributions have pushed you up into the 22+% tax brackets, and you're going to stay there for the rest of your lives, well, then still you're going to utilize this math. Okay, this math becomes really important. So if you're within that 12% tax bracket, then we'll utilize this math. If you're within the 22 or 24, then you're going to start with the top of those tax brackets. So how did I get that chart? Well, that chart is really simple. I go to the IRS tax brackets. I look at the married and single. Married, 12% is $89,000, single is $44,000. I then added the standard deduction to that. I then added for being over 65, and that's how I came up with the numbers on that previous chart. Okay, so we can do that same exercise for the 22% tax bracket, the 24% tax bracket. If you're in anything higher than that, then some of this stuff isn't going to make much of a difference. Okay, 22, 24, yeah, most likely this is going to be a good idea. 12, without hesitation, this is going to be a good idea. All right, so 120,000 married, 60,000 single. Let's look at this. How do we use this number? This number is very important. Whether you're 24, 22, or 12 like we're doing, you're going to start with that bigger number. You're going to subtract out all the income you can't control. So if you're taking Social Security, 85% of your Social Security is going to be taxable. So any pensions, those should all be taxable income. Any interest income, and in some cases, qualified dividends and long-term capital gains, we still want to factor these in as well, okay? So any taxable income that's coming in, including those qualified dividends and long-term capital gains, because you want to capitalize on the zero taxation of that, right? We looked at those tax brackets, and as long as your total income is within the 12% tax bracket, you're not going to pay taxes on those qualified dividends and long-term capital gains. So we don't want to choose to pay extra taxes on those, okay? So start with the bigger number, subtract out all the income that you had throughout the year. You're going to do this in November, December time, okay? And what you're left with is how much you can pull from IRA at 12% taxation. Or if you started with the 22% tax bracket or 24, what you can pull out at that. If you want to I'm not going to say overcomplicate. If you want to complicate this even further, have the IRMA chart. If you're paying for Medicare and you're conscious about what you're going to have to pay in future years, pull the IRMA chart out as well. You want to have these side by side when you're making decisions on how you're going to fill up a tax bracket. Okay, IRMA you don't have to typically worry about unless you're in that 22% tax bracket. Then 3/4 of the way through that bracket, you start hitting IRMA limits and have to pay more on your Medicare. Okay, so this is a handy calculation, and I want everybody to be able to do this. This is something that should be done every year, and you should pull out a little extra of that IRA money. If you don't need it for yourself, you throw it into a Roth account, because then it's tax-free for the rest of your life. Okay, this is a nice little thing that we should be doing to increase and optimize the efficiency of your portfolio, and it reduces the overall taxation. Okay, stop looking at how do I pay the least amount of taxes today. You should always be looking at how do I pay the least amount of taxes in the grand scheme of things overall for the rest of my life on my IRA. We should be looking at it from a much bigger perspective than just how do I pay the least amount this year? Because sometimes choosing to pull money out and pay taxes on it is a really, really good idea. All right. Hopefully this helps. The next one will be the last one. I'm going to show you how these tax brackets work, how things commingle, and how you can really create efficiencies in that portfolio like this one. This is one of those activities should be done every year. We can help in any way. Again, we do this for a living. This is what we look at constantly in all of our clients' cases. Give us a call, shoot us an email. Taxes should be a part of the financial planning process. It should be part of the investment choices. If it's not, then why are we paying the fees? Okay, a good advisor that charges fees should be earning their keep. It should be creating efficiencies like this. And that's how they should be earning their keep. So let us know if we can help out in any way. Give us a call, like the video, share it with friends, subscribe if you haven't, and we'll see you next week.